Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Hello and welcome to Wealth is in the Details with Peter Raskin from Raskin Planning Group. Peter, how are you?
I'm doing okay, Eric. Everything's good. It's just we are in the midst of beautiful spring here in New England, so I'm feeling really good. We've had just a nice run of weather, and when the sun comes out and it's all green, grass is growing, flowers are blooming. It's just wonderful. So feeling good.
Just gorgeous. Yeah, I love it. I could do without some of the allergy stuff, but the sights and sounds of everything, I just absolutely love it.
Yeah, and the smells. We just taking a walk the other day, and it's magnificent. So yeah. I'm happy with spring.
That's fantastic. I know that we are upon another season, and that's what we're talking about today, and that is graduation season. And many, 18, 19-year-olds are graduating from high school, 22, 23-year-olds are graduating from college. And today's topic are, what issues do I need to consider as my young adult child becomes independent? And I love the fact that when we were talking about this, you're like, well, in theory, sometimes they're independent, sometimes they're still fairly dependent. But
it's all in the eyes of the beholder.
Yeah, exactly.
Yeah. Well, I love the question, and the answers are certainly have changed, from one generation to another. I think our parents may have had a real different definition of independence than we actually have, and I'm sure their parents before them had a different definition. So I'll also offer a different answer than I might have if I was asked that same question, when my kids were little. I just had a different perspective. And, back then, I don't think I would have imagined that I'd still be paying for my kids' cell phone, never mind their AAA emergency cards, and then helping out with travel expenses when they come to visit. But I can, and therefore I do, so, but even though they're in their 30s, I consider them all independent. They're doing great. They're great people, and these are just gifts I can do for them, provide for them. So, why not? Yeah. So I think it's about your definition of independence. I think it's important to have these conversations with your kid, kids when it's appropriate, and discuss what that means to you and to them. And I think every family is different. We all define it differently. Many of our clients who are generally affluent, I think this becomes a real challenge because their kids have become used to a certain lifestyle, and thank goodness. I mean, that's a blessing. But full independence after high school or college, just may require a vastly different lifestyle for that child. And they and the parents may not want to sacrifice that at that point. And that's fine too. But I think it's all about open communication, and it's so important to prepare the kids about what they should expect over their time. And I think that those conversations should happen much earlier than when they graduate high school or they graduate college. I think it's important to have those conversations throughout their teen years.
Yeah.
And so that's what I want to talk about today is addressing these questions and looking at it from the general perspective, and then moving to tax and risk management issues that parents might have.
Yeah. And I love the fact that you've really given me a list of questions that I'm going to ask that parents need to be asking themselves, or I guess we're asking them at the same time that I'm asking you these, so you can answer them, because there's a lot to think about. And so I love the fact that you've done this in this format. So I'm just going to start asking questions. Good for you?
Go ahead.
All right, let's do this. All right, so first one is, in case of an emergency, do you wish to have access to your child's important records? And you have some examples: health, academic records, financial records. after they turn 18, and this can be a tricky one.
Yeah, a lot of parents are surprised to know that once their kid turns 18, they no longer have access to their child's health, academic, and financial records. It's just kind of a surprise. Their little child all of a sudden turns 18, and all of a sudden, technically, that information is not there for them. If your 18-year-old or 20-year-old is having a healthcare crisis, you may not be able to speak for them and direct their health care, without technically a court order. And I know that sounds crazy, but that's the way it is. Your child should consider signing a durable medical and financial power of attorney. In Massachusetts, we call it a healthcare proxy, and then a financial power of attorney. So those are two separate documents. And I think it's for those children that are going off to college, especially in different states. I think it's helpful to ask that college, to determine, is it possible for you to receive that academic or healthcare information if the child goes to a college-based healthcare, provider. So I think it's just a question, and it's not. These are not hard things to resolve. Setting up a medical or financial power of attorney is just not hard. It's just a matter of doing it.
Okay, so let me ask you this, along those lines: is this something that you can that you would need an attorney for, or is this like a legal Zoom issue where it can be fairly quick and easy, an online process for these documents specifically? I know that more complex stuff you want to go to an attorney, but are there good documents online that you can get?
Well, I'm always reticent to use online services because you just never know what you're going to get.
Okay.
But a lot of healthcare facilities offer healthcare proxies.
Oh, okay.
So, and there are legitimate healthcare and power of attorney forms online that one could do. So that's possible. These documents are not expensive documents. So if you do have a relationship with an estate planning attorney, they could do it probably for, short money is my sense.
Okay. All right. Next question is your child attending a college out of state, or are they moving out of state? Why do they need to think about this?
Yeah, well, just, I think if they're moving, especially out of state, consider reviewing the out of state, in-state residence requirements, and then determine if it's appropriate. If you have all the appropriate documentation that you need, like driver's license and insurance policies, make sure they're in place and you're covered both in the new state and the old state. If they're attending a state school, maybe there are cost advantages to becoming a resident of that state. So you just want to do that. Just line it up. It may take a couple of years, but understand what your options are. I think it's just a helpful conversation. And then I always just, because it's important to me and my family, just, register to vote in the new state if that's where you'll be voting. Or just know that you'll have to do absentee ballots in your home state. But those are things that are important to me, and not all of our clients feel the same way.
Yeah. No, those are great points. All right. Next question. Is your child still able to be on your health insurance? In other words, are they under 26? Is there any time that if they're under 26, they can't be? Peter, out of curiosity, do you know?
No, as long as they're in school or out, it doesn't matter. They can be on your plan. Okay. That's the law, and that's a good thing. It's just you just want to consider whether it's appropriate for the child to stay on your plan, both from cost and coverage standpoint. There are circumstances where it does make sense for them to be on their own plan. They may qualify for Obamacare, that's subsidied, so it may not cost anything, and bringing them off the plan may save you some money. So just be mindful of those plan costs and how they might change if they come off your plan. So just take a look at it. Doesn't need to spend a lot of time on it. Just take a look and check that box.
Yeah, it was really nice because my daughter, she was 22 and she was still on our healthcare, where my wife works. And then my daughter got a job where my wife works. So at 22, we got to take her off our insurance because she had the exact same coverage through her, on her own. And so that was great.
It's a nice thing.
It is. I'd say, Mom, Dad, just a little bit of money.
Yeah. The important thing is just you want to make sure your kids are covered.
Absolutely.
And, I'm less concerned about the deductibles and co-insurance because, chances are your kids are going to be healthy, but you just want to make sure they're covered for catastrophic stuff.
Yep. All right. Your next question on this list is your health insurance HSA eligible? And does your child plan to stay on it? That's an interesting one.
Yeah. So an HSA is a health savings account, and there's some significant tax advantages to be participate in an HSA, as long as you have a high deductible health plan. That's the only way you can join an HSA if it's available to you. And because of these tax advantages, you just want to look at that as an issue, determine whether your child can be claimed as a dependent. And if they can't, they might be able to open and fund their own HSA up to the family contribution limits, which in 2023 is $7,750, which is a pretty significant contribution. And that limit is entirely separate from your own family contribution limits. So for those families that have the extra cash flow and looking for some tax advantages, the HSA may be a very significant advantage that you can take advantage of. This podcast is not long enough to go into all those nitty gritty details. But the question is child still a dependent? And if the health insurance is HSA eligible, maybe they can move on to their own HSA plan.
Yeah. Yeah. Well, and that's a really, really good prompt for me, Peter, because you're going to answer all the questions that I'm asking you. But like you said, that we could dive into a lot of these different questions very, very deeply. We just don't have time on the podcast. So listener, rest assured, we will be giving Peter's contact information at the end of the podcast, as we normally do. Reach out to him and his team. If any of these questions spark more questions in your mind, which I hope they do, because that's what this is all about, reach out to him and his team. I'd be happy to meet with you and answer any questions more in depth for your personal situation.
Yeah, and it's likely that in the past we've done a podcast on health savings accounts. So if you have questions, you might want to go through all our previous podcasts and see if there's anything that's applicable.
Yeah. And on most of the players, because Peter is on everywhere. I mean, we're talking iHeartRadio and Spotify, and we're not singling any out, although I use Apple, but we're not singling any out. But most of those are searchable as well. So you can search for a title or search for, HSA in his podcast list, and it'll should pop up for you. So take advantage of that. All right. Next question. Do you need to review your budget and expenses once your children leave the house? Well, I can almost answer this one. I would think so, right?
Yeah. Well, I think consider just how your budget is going to be affected. Maybe it's going to decrease. They're not home eating with you, but and so depends upon your continued support and what you want for your kids and what their experiences are. But my experience is that the budgets don't really adjust while the kids are in college. Maybe when they're out working on their own, they do. But, kids are still require clothing. They travel. Some, especially if they're out of state, you may have to help them come back home during vacations. You may be visiting them. You still may be taking them on family vacations. They may be on meal plans, or you might want to provide some extra funding. So just in general, my experience is that the budgets, especially during the college years, aren't necessarily so different.
Yeah, just categorized different, right?
Yeah, exactly. Yeah, but I think it's helpful. It's always a good opportunity to review it. And that's why I asked that question.
No, it's great. All right. Are you thinking of moving or downsizing your home after your children leave the house? Do you need to revisit your financial goals in light of your children leaving the house? For example, are you moving or downsizing? And I love this question because, Peter, that that my wife and we sold our house after the kids had been out for a couple of years, and it wasn't the house that they grew up in, for their entire childhood. So it wasn't like we were, crushing their memories or anything, but that was a huge thing for us. And it was a really good move for us financially. So that's a great question to ask.
Yeah. Many parents are just so excited to make a move after their child or their children leave the house. Maybe it's a couple of years later. They want to change for whatever reason, move into a less expensive town, move into a smaller house, whatever. I think it's a great opportunity. And again, this is just my experience from a planning perspective. It's that next move doesn't necessarily decrease living expenses a whole bunch. And maybe it can in certain communities, it does. But I think it's such an important milestone. And families should really consider their options seriously. And it's a good opportunity to think about where you might be 2, 3, 4, 10 years out, beyond when that actual graduation point comes on. So not every family is raring to make a move right away, but many are. I think it's can think of it as a blank slate, and you can, reimagine a new life without those pesky and expensive kids living under your roof. That, many families are like me. Our house was not so big that when our kids left, we were, we felt like our house was extraordinarily large. So it seems reasonable for us, and it's great for when the kids come home. We like our neighborhood, we like our community, so we're staying for the time being, and no changes we don't foresee any changes in the near future.
Yeah. No, that's great. All right. We're going to pivot a little bit and move on to some tax issues. So the question is, are you planning to help your children with a large upcoming expense? And you kind of have some things listed here: wedding, vehicle, down payment on a house, etc.
Yeah. So I think just, again, it's an opportunity to reflect and see what you want, what your kids need, and, consider how this is going to affect your own finances and goals. We run things through our financial modeling system. We want to know what those goals are. How will it affect your own personal planning if you make a large gift to the kids for a down payment on a house? Around the Boston area, starter homes are could be $800, $900, $1 million. It's just crazy, but that's a reality. Mm-hmm. And so to come down to have a large down payment for that 24, 25-year-old may mean a significant down payment. And so we just want to run that through our modeling. So you want to just remember that if you're gifting any significant dollars to your child, you need to report those gifts. It's an information return. It's a gift to your child, but you can gift anyone $17,000 a year per person without filing a gift tax return. Anything in excess there should be a gift tax return filed. There's no tax due at that point, but it is an informational return that you need to make. So I think if it's an opportunity to reflect, to run this gifting strategy, whether it's a car or a wedding or a down payment on a house, through your financial plan, see how it affects you.
Mm-hmm. All right. Well, I like that last question, and going to tie it into this next one a little bit once you answer this, because I actually have a clarifying question that combines both of these together. So this next question is, do you anticipate your children will request additional monetary support from you even after they are quote unquote independent?
Yeah, and this just leads to more questions, right? Is this going to be a gift or a loan? So it's similar to the question before, mm-hmm. but is this going to be an ongoing? Is this a supplement? Rents are extraordinarily high in a lot of cities across the country, and especially in your New York, your Boston, your LA, any of your major centers. And does your child need an extra $500 or $1,000 or more to supplement their income and to help be in a safe, comfortable place? So the question is it a gift or a loan? And if it's a formal loan, what kind of interest are you going to charge? If it's below market, you want to make sure that that you're doing all of the necessary tax disclosures, because it could be a cost. It could be a cost to you, and you just want to make sure you're taking care of that. And then just understand how these transfers affect your own personal goals. Again, we run it through our financial model, make sure that it makes sense with their cash flow, and if so, and that's what they want to do, that's what they do.
Yeah, and that leads me to my question about this, because in the last question you were talking about, a down payment on a house. I'm thinking about that specifically because with the housing market the way it's been, and the crazy prices, I know that in most cases, and I'm not a professional here, so please don't take this as fact, but in most cases, if you don't have 20% down for a house, you have to pay PMI, primary mortgage insurance, right? So that it's an additional insurance on top of the insurance you're already paying, so that bumps up your mortgage because of that insurance that you have to pay. So being able to help your child get to that 20%, so let's call it a $500,000 house. I mean, 20% is $100,000, right? If they don't have that, and maybe they have 50, if you're going to do a loan for 50 so they can have the 20% down so they don't get hit with the PMI, how do you do that as a loan? I think you kind of alluded to it, where you have to have it's got to be a certain interest rate or whatever, but how do you make it so that the government knows that that's a loan and not a $50,000 gift that you didn't report?
Well, is this going to be a loan that you document? It could be just a,
I don't know. I mean, that's what I'm asking. I guess, how do you make sure that nobody comes back and says, well, wait a second, you gave them $50,000 as a gift and you didn't report it? I don't want anybody to get in trouble here.
Yeah. I mean, so, if it's a $50,000 gift, well, let me back up, because this gets pretty complicated. If your child is buying a house,
yes,
and they have to take out a mortgage, if all of a sudden they have a $50,000 deposit in their checking account, the mortgage company is going to want to know, is that a gift or a loan? Exactly. And they're going to want to know if it's they'll likely want it to be a gift, because they don't want it to be, that if it's a loan, they're going to have to include that in their overall current debt situation, and they may not qualify for as much as much of a mortgage. So it becomes a little bit dicey, depending upon what they're going to do. So if it's not documented, maybe you'll have to show it as a gift. The other thing I will say, that in the current housing market, and I'm seeing this almost everywhere, a lot of the homes, it's just very, very competitive, and people are coming in with all cash, as an all cash buyer.
I've seen that.
And I've seen this all the time. A lot of my clients want their kids to buy their first house, but the kids, they don't have the full cash on hand. And so what we've seen happen is either the full gift of the home purchase, which is a big number, or it is a gift, an informal gift, no interest, is charged typically, and the child, once they buy the place for cash, then they'll finance it.
Oh, okay. All right.
And maybe they'll gift money back to the parents.
Got it. Okay.
So
this is why we're going to give your contact information out.
Yeah. There's just your goal is to have your child purchase their first home, get in the market, but it becomes a challenge. How do they do that? What are the best ways?
Yeah.
Hi, this is Catherine Broy from the Raskin Planning Group. Apologies for the interruption. Thanks so much for listening to Wealth is in the Details. We hope you're enjoying it so far. If you have any questions or would like to talk more about this topic, please visit our website at www.raskinplanning.com. Look for the podcast's show notes and connect with us via social media.
All right. Well, still, in this question kind of surprised me at first, and I thought a little bit more about it, so it makes more sense. But in graduation season, when these kids are getting out of the house or getting out of college, do you or your spouse own a business? Why is this an important question?
Yeah, because you may just want to consider hiring your kids and that could be beneficial in your situation from a tax perspective. So the first 13 in 2023, calendar year 2023, the first $13,850, which is the maximum standard deduction for dependents in 2023, that your child earns is federally tax-free and potentially payroll tax-free if they're under 18. So, it may be a great opportunity to shift income within the family to save on taxes. With the earned income, the child can also do Roth IRA savings. And so if they're maybe even younger than 18, but if they're in a situation where they could work part-time for you, you may want to put them on the payroll from a tax perspective. It's income shifting, and it makes a lot of sense.
Yeah. All right. Does your child have any taxable investment accounts, like brokerage, UTMA, UGMA, which you're going to have to explain to me what those are, Peter, or interest-bearing accounts?
Yeah. So the UTMA, UGMA accounts are typically they're accounts that are in the name of the child, but because the child is not of majority, each state has established basically a custodian account where the parents can establish the account for them in their names, but it's the child's money.
Okay. All right.
And so if it's the child's money, any dividends or interest that it earns is subject to tax at the kid's level. But you just want to be mindful of if that portfolio income, from dividends and capital gain distributions and interest and all that is going to be significant enough that there's going to be a kiddie tax, and that the taxable income is going to be attributed back to the parents. So it's just a matter of understanding how the earned income, which was the question before, and any investment income that they receive can be tax advantaged, and what can you do about that? So it's just a matter of allocating appropriately.
Got it. All right. This is always a big question. Do you need to review whether you should claim your child as a dependent?
Yeah, so this is a challenging question. It's really a question that you need to run by your accountant who's preparing your taxes each year. They can do a study for you, and you just want to make sure that and be mindful of those phase out ranges and the non-refundable nature of education tax credits, like the American Opportunity Tax Credit and the Lifetime Learning Credit. And this depends upon your level of income for the family. And if your income's too low, you may not, appropriately recognize that additional income in order to capture that non-refundable portion of the credit. If your income's too high, it may be appropriate to not claim your child as a dependent and then have them claim the credit instead. So it all depends upon the situation. Who is a child able to be a dependent or not? Who should claim these tax credits? The American Opportunity Tax Credit is good for undergraduate work, college, and the Lifetime Learning Credit is available for graduate school as well. So you just want to run by your accountant the situation and ask, is this something I should take advantage of? If your child is 24 years or older and you're still providing at least 50% of their support, especially if they're attending graduate school, you may be able to claim the other dependent tax credit, which is advantageous if again you're claiming that lifetime learning tax credit.
Mm-hmm.
So it's just really dependent upon your situation. Again, we don't have time today, but I'm happy to chat with people about that in more detail. And it's really a question eventually for your accountant.
Yeah. And this next one, I'm assuming, is going to be similar in nature. Do you need to review how your taxes might change once your child becomes independent?
Yeah. I mean, you may lose any credits or deductions, and that might increase your tax liability. And so you just want to look at that, look at your withholdings, estimated taxes if appropriate, and So it's just, again, check that box. Not difficult, but a question again for your accountant.
Yeah. All right. All right. And early in the podcast, you said that we're going to touch on taxes, and then you mentioned risk management, and that's where we're moving to next. Will your child move to, or do they already attend, a college away from home?
Yeah. So, if they're not living at home, just I think we talked about the health insurance. That's a piece of it, but also, consider purchasing renters or dorm insurance, or make sure, look at your homeowner's insurance policy and see how they're covered there. You just don't want to be surprised. And that's why I bring that up.
Mm-hmm. Yep. I love this next question because I'm a 50-50 on this. I'll just tell you why. Are you concerned your child might not be fiscally responsible? I've got one that's a absolutely, and then I've got one that's absolutely not.
Yeah. I think a lot of families can say the same. If that's the case, consider supporting them by paying for expenses directly rather than giving them cash.
Mm-hmm.
Every child is different, so you think of it as a teaching moment.
Yep.
Be mindful of their access to certain accounts. If they're over 18, some states it's 21, they have complete their UTMA and UGMA accounts at their bank or investment are fully available to them. So you just might want to establish some sort of restriction, whether that's an agreement between just you and the child, or transferring assets into something that's less available to them. And I think it might be a good idea to help them understand, credit cards and debit cards and those best practices. Maybe, and this is something a lot of families do when they're younger, when they're still in high school. But if it hasn't been done, think of this as an opportunity to do that. Maybe become an authorized user on their accounts, so you can track their expenses, not to control them, but to help them understand, good, responsible habits around debit cards and credit cards. I think it's learned information. People are not born with it, and I think you need to have those conversations around it.
Absolutely. All right, next question. Does your child have any serious health issues or disabilities?
Yeah, this is a real important area, and I think becoming more important. Consider those proactive things you can do to protect your child before they leave the house. Example, establishing a support system before they go away to college, especially if it's a long distance away. Check with their college about access to mental health care, especially if they're prone to need those services. And then, especially in the beginning, as they're leaving the nest, be as proactive as you can. The mental health just become a huge issue for young people, really, even before COVID, but since COVID, and we so want our kids to stay healthy. And I'm just hearing more and more reports about young people having real serious problems, and parents are sometimes just don't know those have become issues. So especially early on as they leave, do what you can to stay involved in their world if the child is open to it. And it's a tough one because not all children are. So I think it's an important consideration. Know your child. Be a good parent, ask lots of questions, be there if they need you, and love them. And that's all you can do.
Yeah. Amen. That's exactly right. All right. The next question on the list is your child driving and still considered your dependent? Why is that important, out of curiosity?
Yeah. Well, I always, cars, your kid may be a great driver. Nevertheless, they're still young drivers, and you just want to make sure that you're protected, because if you own the car, you're buying them insurance, and they're driving the car, and something terrible happens, you may be brought into that liability, that lawsuit, and it's something you want to avoid. And so I always recommend transferring ownership of the child's car to the child, and have the child purchase their own auto insurance. Try to be as independent as possible. Let them pay their own premiums. You can maybe gift the premium to them, the amount of the premium, but have them pay it. So just those kinds of concerns, just put up additional walls between you and liability, which is an ongoing issue.
Yeah, that makes perfect sense. All right. Are you concerned about your child's actions or behaviors causing future liability issues for you?
Yeah, unfortunately, that's the world we live in today. And so you just might want to consider limiting the gifts you make to them. Utilize trust that can be there to pay income and principal to the child, but require an independent trustee's authorization for distributions, and that can protect the child from liability and you from liability. So if you foresee that coming, take action, do something about it. Trusts can be a wonderful vehicle, and then just limiting the gifts in their name. I think some families just need to do that.
Yeah, absolutely. Especially, I would assume more affluent families are kind of have a bigger target on their back. Would you say so?
Absolutely.
Yeah. All right. Next question. Will your life insurance needs change once your children become independent?
Yeah, I think it's an opportunity to review these policies and just see if there are any changes that are beneficial. Maybe an ownership change or a beneficiary change would be appropriate, or maybe a reduction in death benefit. Possibly a change to a different product that focuses on something other than death benefit, if that's not as necessary. Maybe, for example, long-term care is something that needs to be addressed at some point in the future, and maybe instead of having premiums go toward death benefit to benefit children that have become independent, you've already paid those major education costs, maybe changing or shifting the insurance coverage from death benefit to long-term care, which is going to be something that will be helpful to your family in your retirement. So just a consideration. Think of it again as an opportunity to check the box. Yeah, I've reviewed that. We're okay. I don't need to make any changes, or maybe we have an opportunity to make improvements.
Yeah. Well, this next one I know you've covered in other podcasts as well, as far as touching on it and teaching about it. But are you concerned about having extra unused funds in a 529 plan?
Yeah, a lot of families have aggressively saved for college, and the students have gotten either grants or gone to less expensive schools, so there's extra money there. And so what do you do? Because if all of a sudden you take that money back, there could be some tax consequences. So you could change the beneficiary to another child, maybe a niece or a nephew. Something along those lines. Or there was a new feature available that because of the Secure Act 2.0, which was passed effective January 1st, 2023. Now, this provision, which allows you to move from a 529 plan to a Roth for the beneficiary of a 529 plan, is a feature that's starting in 2024. Now, there's lots of restrictions to that, and it may provide some relief, something to take a look at. And that's why I mention it.
Got it. All right. Is it time to introduce them to a financial planner that can begin educating them?
Yeah, I think it's so important to just begin the education process early and do it often.
Early and often. Yep.
Early and often. When appropriate, introduce them to an advisor. May not be appropriate at 18. Hopefully the family's been educating the children about banking and credit cards, in their teenage years, and about budgeting and spending and all that. But at some point, it may be valuable for this child to have an independent source, not the parent, that talks to them, that can answer their questions, that can be there as a resource. I know I love playing that role, and we do it often. It's just a great thrill to talk to the young people and answer their questions. I love young people, and it's a great I think of it as a great resource for the whole family. So yes, I think when it's appropriate, definitely introduce them to a financial advisor.
Yeah. And here's the thing. I think every parent knows, and they've had those times in their lives when their child, maybe they've been an open book and talked to them just about everything, but there's sometimes that they just want to talk to somebody else. And that's
Yeah.
okay. That's okay. Right? It's not a control issue. It's just maybe they just want a little bit of privacy to ask some questions that they don't want to feel dumb asking you as their parent or whatever. So being able to have that option, I think is it's a safe place, right? I think that's what's really being provided there, and I think it's great. So
Yeah, just an example of what I've done for my kids. Certainly I could refer them to a friend who's a financial advisor, but I've also suggested that they speak to Catherine in my office, Catherine Broy, who, and I've just made it very clear to everyone that whatever she talks about is completely confidential. And a couple of my kids have felt comfortable doing that, and they've talked to her, and it's been, I think, helpful to them. And I don't know what they talked about, but I'm glad they did, because I trust Catherine and she's great at what she does.
Great. All right. Are your children old enough and qualified to start taking a more important role within your estate documents? In other words, like a power of attorney, executor, trustee, so on and so forth.
Yeah, I think it's so important to begin introducing them to these important financial concepts. What is a trustee? What is a personal, a representative of an estate? What's a power of attorney? These are just important concepts that I think that young adults should know about. And I think you want to begin having those conversations. I think it's also, it's a question. Not every family needs to do this, but some families should think about having family meetings. Disclosing information when appropriate to the kids. They know when something is unique. They know if a family owns a business, their situation is different than other families. They know that they're very, affluent and can afford things that other families can't. The kids know this, and I think it's just, if it's important to bring them into the fold at certain points in time. And just to answer those questions, like, why did you establish these trusts? And the answer in the vast majority of cases is all about love. That a family is concerned about their kids' well-being and their independence and their life going forward. And so that's why people establish trusts. It could be about estate tax planning, could be a little bit about control, but it's because the parents love the kids, and they just want to have those conversations, not waiting until the parents pass away, but well before. Understand what the family real estate issues are. Like if they have second homes, if there's commercial properties, who's gonna start taking on these responsibilities. And I think it's helpful to bring those kids into the fold again when it's appropriate, not when they're 17 or 16, but when they're able and willing and interested is the time.
Absolutely. Well, I am at the end of my questions, Peter, and these families are just at the beginning of their journey. So this is something there's probably still a ton of questions out there that we didn't even cover today. And it's interesting. It's an interesting time for these families. And as their kids become independent, it's an entire process wrapped around every step of the way. What are your final thoughts for the families out there that are listening?
Yeah, so it's like most things financial. I think we get the best results when we think ahead, when we plan ahead. We got to prepare ourselves and our kids for independence. That just doesn't all of a sudden click a switch and have it happen. I think we have to, as I said earlier, communicate with them about expectations, and not to say that it's easy. As parents. As a parent of three kids, three young adults now, they're independent. They're all successful in their own right. But each child is different, and we've had similar independence goals for all three. But they've gotten there at different speeds and in different ways, and each of them is on their own journey. And honestly, it's both wonderful and challenging to watch them from a distance grow up and establish their own lives. Not always easy to do so as a parent, because you just want everything to be easy for them, and that's not always the case. But I think our goal is to have those, is to be open with them and talk to them as we'd want to be talked to, treated as an adult. And that just takes time. So planning is the message. Thinking ahead, think about where you want to be in 3 years, 5 years, 10 years.
Yep. Well, again, it'd be nice to be able to make it easy for our kids. We can't necessarily do that, but we are definitely going to make it easy for the listener to reach out and get more help and get more questions answered by giving your contact info. How should they reach out to you, Peter?
Yeah. So I think going to my website, raskinplanning.com, is a great place to get information, listen to past podcasts, and get our contact information. And glad to chat with anyone that has any concerns or questions.
Perfect. Peter, thank you so much for the info today.
Thank you, Eric. Great to chat.
You bet. And our last thank you, of course, goes to you, listener. Thank you so much for tuning in and listening to the Wealth is in the Details podcast with Peter Raskin. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Peter comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Raskin Planning Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corp. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corp., a broker-dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln affiliates and other fine companies. Raskin Planning Group is a marketing name for registered representatives of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.